As always, we get great comments on our YouTube channel and great questions coming in. Love to see these questions. Get those comments in, get more questions in, guys. So I'm going to start answering a few of them. So here goes. Here's a few of the questions we've had recently. I've got a question here from Deep Sleep Deep. Hopefully you're not falling asleep awake for this one. Is understanding market profile necessary for trading using tools such as Bookmap and Bid-Ask Footprint? It's not necessary, no. But what profile is going to give you is contextual understanding. So you can look at a footprint or Bookmap, and that's going to give you the ability to understand order flow, which is great. But what you can't do with that is know whether you've got a situation where a breakout is more likely or where a market is more likely to range, in which case a Bookmap or footprint strategy is going to be inappropriately used. So the way that I'd be using profile is to define where you think perhaps a breakout is coming, and then have a footprint or Bookmap strategy that directly links to a breakout. So you can say, right, this is what I want to see on a footprint because we are in a situation where I'm expecting a breakout. That's the way I try and bring those two things together. So yes, you can use any tool independently, but having this greater understanding of structure, having a greater understanding of whether something is possible, where that can happen, is always going to improve your ability to trade, because what you're going to do is dismiss those footprint trades or Bookmap trades that just don't stack up with the situation that you're in. So that's the way that I'd be approaching it. Profile gives you massive contextual understanding and basically allows you to time and understand how a market's going to move. Footprint, Bookmap, wonderful. They'll give you the pinpoint accuracy to say right now is the time. That's what a profile won't give you, but footprint doesn't give you something else, and it's using them in conjunction that matters. Okay, this is a great question. So thanks, Casmi977. Answer a simple question. Why the same strategy is profitable for a mentor and a loss for a newbie? Well, there's a few elements to this. Now, of course, the obvious one is that in order to show you a strategy and how it works, a mentor's got to show you one that works. Otherwise, you're not going to see the hallmarks, the characteristics, the inputs before the strategy works. So you need to be able to show someone something that works to be able to explain something to them. So that's one aspect to it. The other aspect is that a lot of the time, any kind of strategy is more than just simply a strategy. So let's take something really simple, a technical pattern. So you're looking at a head and shoulders pattern. There's a simple strategy. Now, someone with some experience is going to look at a head and shoulders and they'll look at that and go, nah, not today. I don't think that's going to work. Or they're going to look at it and think, yeah, absolutely, that's going to work. Now, this isn't a kind of mystical skill set that someone's built up or putting it down to experience. It's the fact that a strategy alone is going to work in certain situations. There's many other inputs into that. There's going to be inputs in terms of how balanced the market is, how much buying you've seen in certain situations, whether you're starting to see the flow coming in that justifies the break. So that you can have a strategy alone, which implies that you see this and this should happen. And the difference between a newbie and a mentor, or a newbie and an experienced trader, is that a newbie is still going to look at each pattern and think, aha, this is a chance, and try and take every single shot. Whereas a mentor is going to look at it and be able to define the one that has the greatest chance of working. And they're going to take that on. And the other factor is, and this perhaps if you're looking at, say, somebody who you're looking at performance over time, somebody who is experienced and is taking the seemingly same trade as you on over time, you're taking the same trade and you're flat, you're not making any money, and they're making money out of it. The other factor is what they're likely to be doing is leveraging that trade up as it goes. So let's say you both take the head and shoulders trade, you both sell at the same price, market starts coming off. as it starts going, as the information starts coming in, for an experienced trader, you're going to look at that and think, this is definitely going to work now. Your probabilities in the trade have suddenly increased, and you're going to add and add and add. So if the trade starts to work and it breaks a certain point and then starts coming back, the experienced trader is cutting out part of that position. So they end up taking a bit of profit. And yes, maybe their original position comes back and they get stopped out. But for a newbie, if you will, they're going to take it with one clip. It goes on side, comes back, stops them out. They lose on the trade. And so neither person's done massively well, but the experienced trader has taken something out of the trade so that yes, they've lost on the initial position, but what they've added on and then realized the move wasn't happening, they've cut out, they've taken some money off the table. And so they've at least got something that when they lose on the original trade or the original position, it still turns into overall net a positive winning trade. So that's perhaps one of the major differences. It'd be really interesting to know, and put your comments in, come back on this and tell me, do you have a specific example of a trade or a trade strategy where you, if you are a new trader, has tried to take it and a mentor has sort of said to you, but this is how it works. So I'd love to try and break that down. You go and look at the details of that trade. So if you've got an example or you can describe an example, get your comments in, let me know on that. And Kazmi977, I'll respond to that and I'll get back to you on that one. Okay, this is a question posted on one of my scalping videos that I put up. The question comes from Random. That's their name on YouTube. So Random on YouTube, I don't see Axia trading NQ. Is that because it's too thin for ladder trading? Well, yes, there is partly that. The Nasdaq is naturally very thin anyway, and I'll try and explain this and walk you through why in a moment. And also there's the volatility element of it. It's quite hard to keep track of where exactly you are when a market is moving as fast as the Nasdaq does, particularly when volatility gets very high, as we've seen recently. Now, with the thinness, it doesn't mean you can't trade it. And thin markets are tradable. And the way you want to look at them is rather than looking at price by price, you're looking at a range of prices the market's trading for. And recently, you could even say the same for ES. And yeah, ES may be moving two handles in a range rather than moving, tick, 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 tick. You see this kind of flow between prices. Now, one of the main reasons why Axia Traders don't, or it's not one of our main markets, is the fact that it's thin. It doesn't enable you to leverage your positions up, because if you can only buy 10 lots at a price, 30 lots at a price, it's hard to build size up. And so that's one of the main reasons why people are going to shift and why people do shift more towards ES than Nasdaq. And it's the same reason why people move away from the DAX. Some people do like the DAX. I'm quite a big fan of trading DAX, and the thinness and the speed in certain markets, you have to ask yourself, does this suit me or not? Some people are not comfortable with that speed. Some people prefer it. But part of this is all down to price and volatility. So let me try and explain this a little bit. If we're going to use really simple maths to try and explain this. If you take ES and NQ, now NQ trades approximately 4 times the price of ES. Assuming that they do the same amount of volume, this naturally implies that you are going to have less contracts per price in NQ than ES. Reason being that you can spread your orders out. So let's take a 1% move in ES gives you a 40 handle move. So there's 1%. 1% move in NQ gives you a 160 handle move. So if you trade in the same amount of volume, you don't have to get your orders filled at one price. You can get them filled across 4 prices and still effectively be able to take the same size movement out of the Nasdaq as you can in the S&P. And this is why it's so much thinner, coupled with the fact that the Nasdaq has lower volume. So not only is it less orders per price because of the fact that you can spread your orders over more prices because of the fluctuation to create the same size movement. Also, you have the aspect that less volume is put through Nasdaq anyway. And so that's partly why it's so thin. So for these reasons, people do stay away from it, because one of the main aims that traders have is to increase size. And there's a limitation with thinner markets, that you start to influence price as your size goes up. Whereas if you move into a thicker, higher volume markets, things like ES, things like treasuries, then it's much, much easier to increase size. And ultimately, it's the ability to increase size, which is where you're really going to gain the most out of your trading.